We're still pretty constructive about US equities.
Yeah.
You talked earlier about difficulty of finding someone who was negative. We are constructive. Our portfolio managers typically are overweight now. Our model portfolios in the US have leaned further overweight into US equities. And actually, I think that reflects the three E's.
Yes.
So election uncertainty being resolved. The second is earnings growth, which continues to beat consensus in the third quarter. And the third is just this broader economic resilience we've seen over the last year and the broadening of earnings growth. So to us, this looks like a pretty constructive environment for US equities.
What about the fourth E, which you and I have visited many times in our career, and that is exuberance. And actually it's IE, because it's irrational exuberance as well. And I get it, there are some terrific companies stateside with great, and I actually think that you've nailed it. You know, the economics, the elections, the earnings potential, but you don't get all that positivity for a cheap price.
That's exactly right. And I think this is why we need more granular exposures and benchmarks for US equities. It's not clear that just buying the market cap weighted index is necessarily the right approach. So we've launched the top 20 US stocks ETF so that investors can express views about the broad market and about that top 20 and control those exposures simultaneously.
Well, that's really interesting. So top 20, not bottom 480.
Yeah, and actually used in conjunction with broader indices like equal weighted S&P plus, say, the Russell 2000, actually allows investors to take control of two slightly opposing trends in the US market. So one is, over the last year, we've seen a broadening of the market. So earnings growth of the other 480 has kind of come up to meet the 20 and the Mag 7 as the economy has proved pretty resilient. But over the longer term, actually in the US, scale has paid off. Companies with so-called big economic moats, because they've got pricing power, they've got
Walmart,
strong networks. All of those companies have typically prospered in the US. And so the top 20 has actually driven 60% of the return in the S&P over 5 years. So as investors want to broaden, to take advantage of this broadening, they also want to be able to control their exposure to the top 20. And if you just go broad, you lose that exposure to the top 20.
Yeah, but as I'm sure it says on every single BlackRock page as well, past performance is not an indicator of future performance as well. So the fact that they've travelled and arrived doesn't necessarily mean they say they can continue it. Or does history say that actually they can continue it?
Well, history says two things. One is always be cautious about valuations.
Yeah.
But the other thing it says is that typically these companies with big economic moats around them, the market tends to fade their long-run earnings potential. And actually, most of the time, they have sustained long-run earnings potential. But I would also make another point here, which is that we've seen more investor interest around actively managing that exposure to the top 20. Because even within the big quality companies, we've seen quite a high degree of dispersion in performance. And so there's opportunity for good active managers to actually beat those benchmarks. So all of this actually is about being pretty granular, pretty selective, not just buying the market cap weighted index.
What about those stocks that just become old industry that actually just fall out of the Dow, fall out of favour? I mean, I hear what you're saying about size, I hear what you're saying about economies of scale and about moats as well, but there's plenty of big ex-Dow companies that actually have just fallen by the wayside. Dare I say it, GE be a great case, and I know to my own pain, I was a GE employee and minor shareholder at some stage.
Yeah, and I think that's why there's an argument for selectivity, and why actually we're seeing interest in actively managing those big company exposures as well. But more broadly, yes, there are companies that fall out. But look, the top 20 has delivered 60% of the performance of the S&P over the 5 years as a whole.